All right, let's get this started. George, I'll keep an eye on the waiting room to let people in as they come in. But for everyone else, again, thank you for being here. I'm Tom Ashley, NAFA Florida CEO out of cloudy and rainy Tallahassee this morning. We've had our share of cold weather around here, is not like you have where you are. But we can always enjoy the rain. We always need that, that's for sure. Not to delay any further, our class this morning is being presented by GeorgeVrban with Fairway Mortgage Corporation. Fairway is a corporate partner of NAFA Florida this year in 2021, and we are delighted to have Fairway on board as a corporate partner for this year. And George, we appreciate your participation and your partnership this year. It's really exciting that we have you on board.
Well, I appreciate it, Tom. And like I said, I love what NAFA is doing and how we're helping out the industry. And I just excited about how Fairway will become, a partner in helping the cause out as well. Our goal is really to team up with you and educate people, obviously, on products like this, for example, and how it actually helps out in essence with all the retirement tools so that you guys are presenting out there. So thank you again. Appreciate it.
Oh, our pleasure, and thank you. We appreciate it and enjoy the partnership. We're always looking for good partners in terms of NAFA Florida and sponsorships and so on and so forth. And we like to think that our partnerships are very good quality companies and entities who you would want to do business with every single day. And again, Fairway is on board as another partner this year. We really appreciate it. Before we get started, many of you may notice that silly little cartoon behind me in my background. And that's, if you can't read it, that's a NAFA eagle. It's got NAFA written on him. And the people going over the cliff with new wings there are agents and members of the association saying, "Don't worry, NAFA's got my back." And it's a funny little cartoon there, but that really is true. If you're not a member of the association, if you're a non-member, we would love to have you as a member of NAFA and NAFA Florida. So just know that this is your professional association. If you're in the business of life advising, health, annuities, securities products, so on and so forth, the property casualty line, we're here to help you and be your professional association. Our goal here is to help you grow your business each and every day. So if you're not a member, give me a ring. I'll put my contact information in the chat room here in just a moment, and you'll see that. I am going to keep all of you muted throughout this morning's class. And if you would like to unmute yourselves, we have the capability, you have the capability of unmuting yourself to ask a question. I think, George, we might prefer if they would use the chat feature first, and I'll keep an eye on that and pass any questions along to you, George, from the chat feature. This class is 1 hour. Might go a little long. I don't know, George. That's up to you. But the truth is, it's nice to have all of you here. We'll keep an eye on the chat feature. And George, I'm going to turn it over to you now.
All right, appreciate it. It all depends, Tom. It depends on the reactions that I see on people's faces, whether I should keep it to an hour or less. So I'll look at their body language as well when I'm watching this. All right, so a little background, guys. First of all, my name is GeorgeVrban. I've been doing this for about 15 years, educating, teaching people about the HECM product and how it's used in as far as a retirement strategy. So I'm going to get a chance to really first kind of talk about maybe some of the misconceptions and myths before I can go into some of the retirement strategies that I show with clients. So I'm located right here in St. Augustine, Florida. It's nice and foggy and rainy, just like Tom's situation as well. Seems like the whole state's that way today. But with that being said, let's just go right into it, and we'll get a chance to see what we can do to answer any more questions here as we get going. All right, so the very first thing I want to talk about is with Fairway. First of all, we are a corporate sponsor. We're in 49, 50 states throughout the United States, and we do have reverse mortgage planners throughout the whole country, and including a couple here in Florida as well, beside myself. And we're always about a team approach, so we're always trying to figure out how do we help people out through all the different when you cross over the borderline, if you have clients in other states. I'm currently licensed in 9 different states. I work with some of the top financial planners and insurance agents in the country. and also realtors teaching these different strategies. But I want to get into, I'm not sure how many people here on the call are familiar with Dr. Wade Pfau. Dr. Wade Pfau is a professor at the American College. I got a chance to meet him, super nice guy. He actually came up with the RICP, Retirement Income Certified Professional designation. And what he focuses on is really the deaccumulation of wealth, right? Spending down assets. When people get in the retirement age and they're not working anymore and bringing income into the household, the key is, what are some other tools that we can go ahead and investigate to find out what we can do to improve the sustainability of the retirement income? Well, he actually researched and did his due diligence, and have done tons of Monte Carlo simulations to different probabilities, and he's come up with many statistics, white papers, everything you can think of that can show how a reverse mortgage product can actually improve the probability of your or sustainability of your retirement income. So if you want to look him up, it's Dr. Wade Pfau. He's with the American College. All right, so I'm going to talk about real quickly. When I speak around the country, I run into about 5 to 6 most common things that people keep asking me. And I'm going to eliminate this right now so that way we can get this behind us. The very first thing people ask me, they go, George, I want to look into a reverse mortgage. I hear about this. It can be obviously used as a tool, but I heard that the government takes the house. I heard that you lose title to the house. And the answer to that is not accurate. This product is actually called a HECM. So what the HECM is a HECM, right? HECM stands for, HECM stands for Home Equity Conversion Mortgage. It is nothing more than a home equity line. Matter of fact, the reason they really call it a reverse is because what people don't know is that you can take it from a traditional mortgage and switch it to an optional payment plan. You literally can make a payment on a reverse mortgage product. Most people didn't know that. So all we're doing is we're just really taking an opportunity of taking a situation where you're obligated and you have to make a payment to where it's now an optional payment if they really want to. It was designed as a tool back in the 1980s to help people free up that mortgage payment to do what? To create cash flow, right? That's what it was designed for. And Ronald Reagan came in the 80s, tried and tweaked the program back then, but our program needed a lot of tweaking. And we probably have more tweaks in the last 6 to 7 years that I've been doing this than you can shake a stick at. But today it's probably the most scrutinized loan in America today, but it's also probably the safest because of it. I can tell you this right now with just from pure experience from doing this for 15 years. In the last 2 years alone, I can't tell you how many financial planners I work with today versus what I used to do the previous 13 years. I've seen financial planners in particular investigate because it's part of their financial fiduciary to investigate and do their due diligence. And they've actually done the research and they say, hey, look, it obviously makes a lot more sense now. They put these safeguards into play. So now it has all these protection features. So now they're embracing it a lot more today than they ever have. So that's the good news. So their changes have been for the better. But you have total flexibility. There's no prepayment penalties on these kind of mortgages. You can actually have total control. You can get out of it in 2 months, 10 years, whenever you want. It is something that is completely flexible. All right, so that's number one. Number two, people ask me, well, George, if that's the case, how does the concept work? Because I do have a follow-up question to that. And the first question people ask me is, how does the concept work? Well, what they do is they take the age of the youngest borrower. At least one borrower, if they're married, has to be at least 62 years of age. And what they do is they take the youngest of the two borrowers and the appraised value, and they give you a percentage of the equity of the property. So if you're in your 60s, it'll be roughly closer to the 50% mark. If you're in your 70s, it'll probably be closer to the 55% mark. And if you're in your 80s, they obviously give you a little bit more and closer to the 60% mark of the equity of the property. So that's what they try to do. So the follow-up question people ask me, and they go, George, well, if that's the case and you are borrowing this money, this equity of the property, and you don't make a mortgage payment, doesn't the interest grow on the loan? And the answer is yes, because you're not making any more payments anymore, right? So then they ask me, they go, well, if that's the case, doesn't the reverse mortgage then eat into the equity of the property? And the answer again is yes, it does. But there's two things you've got to take in consideration. Number one is that the property is going to appreciate in value. So even if it's 1 to 2% a year, it's still going to offset some of the interest that's growing on the loan long term. But what people are willing to do is sacrifice a little bit of their equity to do what today? Is to gain cash flow today, right? So what we're doing is we're physically putting more money now in their pocket today instead of physically waiting for down the road on their, when that time comes and they want to sell the house or when they pass away and pass the equity on to the kids. They're using it today for their own personal retirement strategy. All right, so that's number two. Number three, people ask me, well, George, let me ask you this. Can the kids inherit the house if they do a reverse mortgage? And the answer is yes. This is no different than any other mortgage. The kids can actually pay off the mortgage and keep the house. But this is one thing that I've noticed that's happened over the years that I've been doing this in the 15 years. And there's one dynamic that's changed today in America. Does anybody know what that is? What's one dynamic that's changed with people that are in their 60s and 70s? Well, I'll help you out here. Basically, with the one dynamic that's changed is that everybody's getting older. They're living longer, right? So the people are getting into their 80s and 90s. The kids are in their 50s and 60s. So when the parents ask their kids, do you want the house? Guess what the kids say? No, they don't want the house, right? What do they want though? The cash, right? They can care less about the house. They just prefer to have the cash. Why? Because they already have their own place. They're not worried about or concerned about trying to figure out, how to keep the actual house. It's a rarity that you run into scenarios like that, but I do have one out of the 15 years I've been doing this work. It's been in the family for over 70 years and they wanted to keep it in the family. So that's a unique scenario, but that's not the norm. All right. And then the other opportunity, what people don't understand is that that the loan, if for some reason the loan ever superseded, the interest grew on the loan long term and it was worth more than the actual value of the house, the kids would then come in and say, well, yeah, I would be interested in the house. In that scenario, they can actually buy the house at 95% of the appraised value, not the loan amount. So even if the loan amount was 10 times higher than what the value was, the kids can actually purchase the house at 95% of whatever the appraised value is. And the difference is being absorbed by FHA. So this is something I'm going to go into the next piece. So there's a couple different ways the kids can inherit the house. One is actually just paying off the mortgage if there's plenty of equity left in the house. And even if it's upside down, it doesn't matter. The kids are protected and they can actually purchase the house at 95% of the appraised value. All right, so with that being said, it leads into number 4. People ask me, well, then how come closing costs are more than normal on a reverse mortgage? Closing costs are more than normal because this is not a conventional loan. This is a government insured loan by FHA. How many on this call have served in the military? Just a slight raise of hands there. Anybody in the military on this call? If you are, then I'm sure you've heard of a VA loan, right? It's insured by the Veterans Administration, which is a government loan. And what a lot of people don't know about is there's a funding fee, right? That gets rolled into the loan. You got all these perks and bells and whistles, but there's a funding fee as much as 3.5%, depending on your years of service, that gets rolled into the loan. Well, on this product, it's an FHA loan. It's only 2%, but still, this is extra 2% is what makes the closing costs more than normal. Now, what are they getting in return for this FHA? What they're getting in return is peace of mind, knowing that the kids are not on the hook for anything that's upside down in the event something happens. Because that's the fear of a lot of clients that I have, or parents are like, I just don't want to leave the kids with any debt if I do this strategy. And they're not. And let me kind of give you numbers as an example. I'm going to do easy math. If the house is worth $200 and we give you access to $100,000 and interest grew over time and it grew to $150 and the value never changed in 10 years, that's easy math. You sell the house for $200, pay off the $150, the other $50 goes to the kids. Nothing changes in that scenario. But let's say for some reason they lived in the house for 20 years and their house is worth their house is worth now only $180. We had a market crash, but they owed $200,000. But the house is only worth $180. So now what happens? Well, what they would do is the kids would still settle the estate. And what they would do is simply get 180 grand to go towards the $200,000 deficit. But who do you think is responsible for the upside down $20,000? Can anybody take a guess? Who do you think it would be? Would it be the kids? Would they go after their assets? No, right? So the government will come in and write a check to the bank for the difference, but the kids are not responsible for any upside down debt. Here's one strategy that I show, because I work with I got a chance to be with Dr. Barry Sachs. He's a U.S. tax attorney. I got a chance to spend some time with him in San Francisco, actually in Wisconsin. And we spent some time together. And one of the things that people are not even aware of, and this is some of the strategies that we show, is I'll give you an example. Let's say in that example there, that interest accumulated over time on this reverse mortgage. Well, believe it or not, once the house gets deeded over to the child's name and they sell the property, believe it or not, even though the loan was upside down, people think, well, gosh, the kids are not going to walk away with anything out of here. That's not true. The kids can actually inherit a personal tax deduction for their own personal estate from all the interest that grew on the reverse mortgage over those years. And it can be actually passed on to into the heirs, which would be the children. So the house can actually be deeded. Once it's deeded over to them and they sell the property, they get to inherit a big tax deduction in that example. So this is just just a little snippet of some of the tax deductions that we talk about in this case. So the kids will always walk away with some kind of money, no matter what it might be, but it might be through a tax deduction or whatever the difference is in the equity of the property. All right, so that's number 4, that's why closing costs are more than normal, because that's that protection piece that's put into play. All right, and the 5th and final thing is fear of the unknown. People just don't understand how this product works. So what they do is they physically hear these stories, these horror stories, and they hear people that, oh no, this guy lost a house because of a reverse mortgage. But if you investigate, you find out they didn't follow the rules. So what are the rules? You got to pay your property taxes, you got to pay your homeowner's insurance, and upkeep of the house. You have to do that regardless of whether you have a mortgage or not, right? Or even if you have a regular mortgage. But unfortunately, we got stuck with that stigma. When people would not follow the rules, they would blame it on the reverse, but it simply boiled down to people just didn't pay their taxes and their insurance, which is a requirement on this particular program. All right, so with that being said, this is what's happening today. We have 10,000 people a day hitting 62 for the next 20 years. And 44% of those people are making mortgage payments still. And there's still 10, 15, 20, 30 years of a mortgage payment. I ran into a 75-year-old that took out a mortgage for 30 years at 75 years old. So these are things that are happening out there today. There's a big demographic shift that's happening with the baby boomers. So this is what's happening there. So this is, on this particular slide, you have that 62, 84% are most likely going to run out of money. At 66, 50% are most likely going to run out of money. Why? Because there's lower savings rate, fewer pensions, lowest return on investments in decades. So there's a greater need for security and certainty than ever before, only because what's happening today is that people are living a lot longer and outliving their money. So this is what's going on today. So the other slide I want to show you here is basically how the industry as a whole, we have a big billion-dollar credit card industry. We have $1 trillion in auto loans. We have student loans. We have about 5.8 trillion in 401ks. This slide is already outdated. There's about $7.25 trillion of home equity that just sits in people's homes that doesn't generate any income for them in their retirement. And then you have IRAs that's closer to $8.2 trillion. So these are amazing, some pretty fascinating stats here as far as that part is concerned. All right, I'm going to go into this particular piece. With this being said, and when I get done with this particular piece, then I'm going to go into sequence of returns risk. I'm going to talk about some conversions. I do IRA conversions with clients, with the financial planners, not me personally, but the financial planner does. And I do some strategies regarding some tax strategies here. So I'll be talking real briefly about some of the different strategies we use this product for. Okay, this bucket right here, this screen to me is probably one of the most important slides to me in my opinion, because This is where it makes sense for a lot of clients and for financial planners when I get done explaining the concept of why we use this product as a retirement tool. So I'll give you an example. You'll see 3 buckets in the screen, and we call this kind of the pre-retirement income bucket. This is your pre-retirement wallet. And let's assume that you're still working and you're doing everything you can to work from the ages of 18. And by the way, I have people that work into their 70s and 80s. This screen is also outdated, it says 61. But what happens is people go ahead and do everything they can to earn income, and they put money into bucket number 2. And you start setting aside 5 to 20% of your money into bucket number 2. And that's simply your 401ks, your lumps, your life insurance, IRA, which by the way, I'm going to probably be your biggest advocate for life insurance. If any of you on this call offer life insurance as part of your portfolio, I can't tell you a better legacy than life insurance to leave. It's tax-free. It's actually paid in 30 days. And for me, what's simple about this concept is this. You have 3 pieces that are important with life insurance. You have liquidity, you have use, and you have control, right? Those are important parts of that particular. And what's the collateral? It's the life insurance. And I'm going to show you how the house also plays the similar role as life insurance. So people do everything they can to go ahead and put money into this particular bucket. Now, at the same time, they're setting aside 25 to 40% of their bucket, and they put it into bucket number 3. And they have to, and that's their house, because they need a place to live and they need a roof over their head. So this happens over time, right? We've been trained to do this over our lifetime. But a funny thing happens, right? When we put money into bucket number 2, it's liquid, which means what? That means you can pull the money out if you have to at any point in case of an emergency popping up. But what happens when you put money into bucket number 3? It's no longer liquid, correct? Now it ends up turning into equity. So the only way you can get access to this is to do what? Sell the house, refinance. But if you do and you pull cash out, you still got a mortgage payment. But it's the only way to pull money out of these funds or out of this money that's trapped in the house. So on paper, I always have people look at their financial planners will look at their portfolio and they look at their assets, and you can have an absolutely beautiful house paid off nice and there's free and clear and it looks great on paper. But what people are forgetting is that when you put money into a house, it's considered an illiquid asset, right? So this is an asset, but it's an illiquid asset. So what we're doing now is when you retire and you're not making any more money, you have to spend down your assets. And now we're in our post-retirement years down here. And now we're going to start spending down our assets. And guess what? We go back to bucket number 1, and we're going to now spend down Social Security income, pension if you're lucky. And then what ends up happening is when you start obviously living in your retirement years, you start emergencies pop up. You might need to tap into some of your investment nest egg. And all of a sudden now we start depleting this bucket. Well, this is the way this product used to be viewed. People would deplete this bucket because this is the only thing that we were trained to do. We would go to this bucket and we just start spending the money down because we don't have anywhere else to pull money out of. Well, what happened was when people would run out of money here, they would look over here to this bucket and they go, hey, let's look at a reverse mortgage now, because it was viewed as a last resort or a desperation type situation because we ran out of cash. And what's happening today, and where I call a tipping point is changing today because financial planners are figuring it out and insurance agents are figuring out that, hey, we do have another tool here, that if we coordinate this strategy and we simply do a reverse mortgage early in the game and we redirect their funds instead of going into an illiquid asset, if they're still working, we can put that money back with who? The insurance agent or the financial planner, and we're going to redirect those funds back into this bucket. If they're not working, then what we do is we redirect those funds back into their pocket. Ultimately, what that does, it means that they spend now what? Less of this bucket. So if we redirect their funds and we put money back in their pocket here, what ends up happening is this bucket ends up stretching out a lot longer. So the legacy we leave behind for the kids are going to be this bucket. It's not going to be this bucket, even though there will be money left over because the percentage that people get today are a lot less than it used to be in the old days. So they're not only going to get money from this bucket, but what's going to happen is the clients today are going to make this money stretch further because this is important. Cash flow is king. We need everything we can to go ahead and make this money stretch. How many people on this call have heard where financial planners today on the withdrawal rate today on your portfolio has gone down from 5 and 6% down to 4%. And now with the pandemic, it's dropped down to 2.5 to 3%. How many people have heard that? If you have, this is unfortunately what's happening is people are doing everything they can to try to figure out how to make this money stretch. So this is the reason why the financial planners today are embracing more to put this product into play early in the game so we can prevent people from spending down bucket number 2 and make the cash flow last a lot longer. Hopefully this makes sense. Does that make sense to everybody on the call? Yes? Okay, good. All right, so with that being said, the next thing I want to do is I want to show you a software that I use that I actually show as a visual with clients to show them how we can actually make their cash flow last longer. So I got a couple different examples that I'm going to show you up on the screen. And let me know if everybody can see the screen. All right. Can everybody see the screen up here? Can you see where I have all this information, this data? I only see a couple faces, but if you can nod your head, just let me know that you can see this. Okay, so this is how many people on this call are using, can you put in the chat box for me, what financial software are you using? If you're an insurance agent, obviously you might have different software for your insurance products, but if you're a financial planner, what software are you currently using? Is it Money Guide Pro? Is it eMoney? I've been teaching for years how this Heckem product works with Money Guide Pro. But now I'm going to show you another version. I don't know if everybody's heard Money Tracks. Let me see here. I want to, okay, eMoney. All right, I see somebody put eMoney in there. Thank you for sharing that. All right, so there's another financial planning software called Money Tracks. And what happened was we got a chance to get with the CEO of Money Tracks, and we teamed up with them. We created our own proprietary software system called Equity Tracks that's just geared more for Fairway employees to team up with the financial planners, insurance agents, to show them a visual effect of how this strategy works with this particular product. So I'm kind of just basically go through a couple things here just to kind of show you some basics. But on the far left, you're going to see a fact finder sheet. It's no different than what financial planners do. In this example, this is a client that's 63 years old. They currently have $100,000 in their savings bucket. And in this savings bucket, that means anything from IRAs to savings accounts to 401ks to whatever the investment portfolio might consist of. And I put an average savings return rate of 5%. If their property value is 230, I even put a conservative 2% appreciation on their property value. They currently have $106,000 of a mortgage balance and a mortgage payment of roughly $950 a month, and still 140 months left at age 63. So what are some of the important questions that I would like to ask a client? For me, in the financial planner, the first thing that this client wanted to do at 63 years old, the first thing they did was they said, you know, Mr. Financial Planner, I'd like to go ahead and start claiming Social Security income. So the question is, just put a yes or a no in the box, in the chat box. But if you had a client that's still working and they're 63 years old, and they have still a portfolio there, would it be wise, and this is just generic, I know there's more questions to ask and there's more details to look into, but just off the top of your head, would it make sense for them to do a Social Security and start receiving Social Security at age 63 if they're still working? Just put yes or no on the box. All right, and what's the main reason that we would prevent them from deferring their Social Security? The reason you would defer the Social Security is because the major question we're finding out is they still want to work, right? So why take out Social Security income at this age bracket? So the financial planner that works with me said, you know, look, Mr. Client, before you do anything, I'm going to show you another tool we're going to use. We're going to come up with a couple different strategies on how to defer your Social Security. And the question is, how far out do you want to keep working till? In their example, they wanted to go ahead and work until at least 70 years old so they can have basically full retirement age, right? So in this example, what we're going to do is go through an example of how it looks like paying off an existing mortgage, freeing up cash flow, and then deferring their Social Security. So watch this screen. So here's what we're doing. We're doing a couple different things, right? We're going to incorporate home equity into a retirement income strategy, and we're going to convert what we call a traditional mortgage into an optional mortgage payment plan now. Now, with this being said, this is what the screen looks like next. You see these buckets. And this is what happens over time. And let's just say he never changed the strategy. He accidentally took out his Social Security income, and he has his $100,000 savings portfolio here. Here's his mortgage. There's his equity in this property. And we go ahead and start taking this out. Let's take it out 7 years. So now all of a sudden we start, well, I want you to notice this particular bucket and the equity of the property and then the savings bucket here. So these are the three things I want you to focus on. All right, with that being said, we're going to take this out 7 years. And if you notice, I'm taking this to age 70 years old. And yes, he did a great job of paying down his mortgage, but he still has mortgage payments, even at 70 years old. He accidentally took the Social Security out a lot earlier, but his savings bucket here, I want you to see 7 years later is only $141,000. Yes, he's got equity in the property. This is what we normally see. And this is what it looks like after 7 years. So now let's look at another slide. And in this particular slide, I'm going to show you a side-by-side of what a HECM product can do versus paying off an existing mortgage and doing the normal mortgage payment. So now watch what happens. And I'm going to take this out 7 years, and we're going to wait, right? We're going to do two strategies. Number one, we're going to physically go ahead and prevent them from taking Social Security out till age 70. So now we maximize their full retirement age with those 8% increases in their Social Security benefit. But what do you notice differently here? Maybe just a slight bucket difference between this bucket and this bucket. If you notice, their loan balance is still higher. And yes, they have lesser equity, but where are they saving money? Look down here. If you take a look down here, all the way down at the bottom, how much do we save them over the 7 year period? Cash flow, we saved them literally $80,000 over that 7 year period. Plus we deferred their Social Security bucket out. So we've done two different things to improve their scenario, because what we did was not only, and if we kept this scenario the same over here on the left, nothing's changed. They're still obligated to keep making a mortgage payment, and their bucket only increased by 140. By simply using a simple strategy, we just created $80,000 more of cash flow back in their bucket. That's part of that liquidity, in addition to that $143,000. Now, there's some beautiful things about this that I talk about. I go a little more detail, but I can't do it on this call. I talk more about some of the tax strategies. I show how to offset their physical tax liabilities. For people on this call, people always ask me, they go, George, how come you have millionaires that are doing reverse mortgages? And I can honestly tell you, a lot of my clients have a wealthy portfolio. And I can tell you this from just pure experience, nobody wants to donate to the government, right? So they're doing everything they can to shelter their tax liability from the government because they want to leave more money for their family. So what we're going to do is, this is just a little snippet of showing you how to defer Social Security. This is one strategy, but also paying off, creating more cash flow over the 7 year period and deferring the Social Security out. So we created a better snapshot of them in their future in 7 years out. So the tax strategy side of it comes a little later in the game if they have to pull out any money out of their investments. And that's something that I'm not sure I'm going to have time to go ahead and do in this particular. But what I would do and be more than happy to do is, I actually have case study sheets that if you have a client and has a portfolio, I can literally show you some tax strategies, how we can literally offset their taxes on their liability over time. I'll give you an example. We have a Southwest pilot right now that we literally came up with a strategy. I have a doctor. I've already come up with the strategy of writing off anywhere between $40,000 to $60,000 of taxes every 4 to 5 years for the next 20 years. So over time, by using this product the right way, we literally show them about a $200,000 of tax savings by using this particular product, by just simply swapping out their traditional mortgage for a reverse mortgage in this case. Most people are not familiar with these strategies. They have no idea, but this is just some of the things that I wanted to show you as well. Now, here's a fascinating screen. To me, this is my favorite screen. If you want to take a look at this, how many on this call are insurance agents? And then how many, just type in the box, insurance agent or financial planner. If you're a financial planner, I'm assuming you do insurance products. But so if you're just strictly an insurance agent, or are you a financial planner? Just type that in the box real quick. Okay, I got a couple insurance agents. Okay, got it. I think I had one financial planner and the rest are insurance agents. Okay, so I just did a strategy with an insurance agent about leaving legacies behind for their kids. And we talked about a couple of different strategies. I want you to look at this slide very closely, because this is what I just did with an insurance agent. So with a HECM, when you put this into play, you've got a couple different scenarios in this case where you have options. Now that we free up this $950 payment, we can either redirect the money back to bucket number 2, or actually in this case, bucket number 1, back to the liquidity bucket and back to the insurance agent, or we can put the money back into the credit line fee, the loan amount with the HECM product in play. So let me show you how this works. If I free up their mortgage payment of $950, and let's say we want to put $450 back in the client's pocket of the $950, because we freed up that cash flow. But now they want to take $500 of their money and they want to put it back with the insurance agent. So maybe now we put an IUL policy, or we do a long-term care strategy. If you sell long-term care, I'm going to show that in another slide. But what we're going to do is I'm going to take this $500 and I'm going to step it out for 7 years and watch the difference in 7 years, how this increases here on the far left. I'm going to take this out 7 years. And I want you to take a look at a couple different things. Number one, look at their liquidity, because you help them with their insurance policy provide liquidity, use, and control with the life insurance policy by increasing their liquidity bucket, because life insurance is part of that liquidity bucket. We also have cash flow of an additional $37,000. But this is how much you've improved their scenario in 7 years. And then on top of that, we defer their Social Security. So what I'm doing is I team up with the insurance agent, or I team up with the financial planner, and we say, hey, look, let's take this $500 and let's say you tell me that we're going to have a game plan of trying to free up the cash flow to go ahead and do some other insurance products. I don't sit there and tell people what to put it in. That's not my responsibility. That's not my job. I am not an insurance agent. I am simply teaming up with the insurance agent or the financial planner to show them that if we free up this money, it allows you now to do other things to fill the gaps in that people are missing, which is in a lot of cases, life insurance and long-term care. Those are two of the areas that always suffer, right? But those are the things that you have to come up with, because I am going to just show strategies how to free up the cash flow to do those particular strategies. So hopefully that makes sense in that example here. So what's interesting, what's fascinating, a lot of people don't know, again, is you can put all or let's say we put $500 of money back to the insurance agent, but we want to put $450 back with the loan balance. And I want you to take a look at this particular slide here. I want you to look at this number right here, and you see how over 7 years, we paid the loan balance down, and what did it do? It automatically created $42,000 credit line that they can pull the money back out. You can't do that on a regular mortgage. If you pay down a reverse mortgage, you can actually have the ability to pull funds back out again, tax-free. And then if you take this number added with this number, it's now liquidity wise, you have 193 plus the 42 gives you the $236,000. So that's where, again, a lot of these different strategies we come up with, but we can literally sit there and plan. That's what I do with my clients and my financial planners and the insurance agents. We do a whiteboard and we sit there and go, okay, this is what I'm trying to do, George. How would this come into play and how do we structure it so we can free up cash flow to go ahead and do these different projects? So this is the different concept that we're trying to show. All right, so let me just show you one other piece of information here. It's called a home equity line of credit. This is for people that always come up to me and they say, George, well, I don't have a mortgage to pay off. So what about me and what's my situation look like? Well, this is somebody with a high-end home, very expensive home, and we're gonna just create a line of credit for these clients. So what you're gonna notice, and this is what people don't know about, but the line of credit that grows on a reverse mortgage, if you do not use this line of credit, let's say they don't need the money, this is tax-free money that they get to use down the road for any reason that they want. It's their money. I had one in Tampa, Florida. They just took part of that money and they just bought a second home in North Carolina. The other part of the money I'm using is we're taking their traditional IRAs and converting it into a Roth IRA. I'm going to show them how to pay the tax liability using this particular product because we're using tax-free money. Again, there's many, many strategies that I can show you here, but one of the things I wanted to point out is this particular credit line actually grows at 3 to 3.5% guaranteed minimum every year, regardless of what the market does. So if you, in other words, if you do not need the credit line at this point, and if you look at this example here, we're going to take this out 5 years, and let me just show you how the credit line grows. 5 years to 88 years old, it went from 360 up to 437,000 that they have access to. So that is a tax-free bucket for people. Maybe you might have a long-term care policy, you want to sell a client, but you can't because he's got health issues. Or maybe he does not, or the premium is too expensive and we can't get him to qualify. This is another solution to help people out to use tax-free money, to use this first before depleting their liquid bucket to help offset long-term care strategies. I can't tell you how many clients of mine have burned through their assets because they don't have a long-term care policy or a life insurance policy, more importantly, with a long-term care rider, and they don't have it. There's many people out there that don't have this feature. So this is another way to go ahead and help them either get an IUL policy with a long-term care rider, funding it through this process, or going ahead and using the line of credit itself if they can't qualify to help fund long-term care strategies. So you're providing a solution for your clients. But this is another tool that we can use together at this particular point. All right, so let me kind of elaborate just a little bit more about traditional IRAs. Everybody agree on this call that one way or another, you're going to either pay taxes now or pay taxes later, correct? The question is, how much are you going to pay today versus what you're going to pay later? Would everybody agree or have a fear in their mind that the taxes will possibly go up down the road after another 3, 5, 10 years from now? Do you think the tax codes are going to get better or worse? What's your gut feel? You think worse? Type it in the box. I'm just curious. I want to see your perspective on the tax codes and what's going on. And I want to see how many people are familiar with the Secure Act. Okay, it seems like it's a pretty overwhelming response of yes, taxes will be higher. So my question to you is, again, if we want to help a client out and protect these, and by the way, if you're all insurance agents, how many people have heard of David McKnight? Anybody heard of David McKnight? I got a chance to spend time with David McKnight. He's an author. He wrote a book called The Power of Zero. I got a chance to spend some time with him. We're both on the same page. What is the best tax bracket to be in? Zero. How can you provide a zero tax bracket on some of the products? Life insurance, tax-free proceeds. This is the reason why I'm a big proponent of life insurance. I am your biggest advocate. So this is one of the things that with the IRAs today, what's happening is in the Secure Act today, the IRAs can be passed from the husband to the wife, no problem. But Congress already changed the rules that for an IRA to be passed down to a child, it now has to be spent within 10 years. So can you imagine if you have a client that has $1 million IRA, the spouse passes away and they want to pass it on to their child, they're required to spend all of that $1 million in 10 years. Do you realize what kind of a tax strain that will put on that child? Because it'll kick them into another income tax bracket. They'll pay more taxes and they're going to ultimately lose 30, 40, 50% of that IRA. So how do we shelter it again? Again, life insurance is another way to shelter a lot of this stuff. So we've got, I can go on and on as far as the different products that we talk about here, but I wanted to just show you some of the software that we use to kind of team up with the insurance agents and the financial planners and figuring out what are some of the strategies that we can put into play with the actual clients. I'm going to stop right there. Tom, so what I'm going to do at this point in time is, and like I said, I want to go ahead and see if there's maybe 1 or 2 questions I might be able to answer. But after this, what I want to do is get a chance to, if questions I can't answer, I'd be more than happy to answer on a personal basis. And like I said, I thank you everybody for just jumping on this call. Hopefully it was informative enough that this is not a boring, typical reverse mortgage presentation. This is something, if used strategically and correctly, can be a valuable tool to help people's retirement strategies down the road. So hopefully you enjoyed it.
George, what I might suggest at this time is if you want to enter your contact information in the chat feature while they're coming up with the questions, how can they reach you? What would be the best way?
Thank you. Probably through email, probably be the best way. That way I can pass information. For example, I have white papers. I can prove all these different strategies. I also have information about on a PDF. I have reverse mortgage information regarding how to purchase a house. I haven't even talked about a purchase, which I might end up on that note, by the way. But I'm going to show you one particular strategy. And thank you for asking for me there, Tom.
Sure.
Okay, so one last piece. What people don't realize is when people come, how many people know about all the people moving from up north are coming down here with a particular amount of cash, right? So I have a lot of people that go, well, George, I got $400,000 of cash. I want to buy a $400,000 house here in Florida. The first thing I say to them, I say, look, first of all, why do you want to pay $400,000 in cash for a $400,000 house? And they go, well, I don't want to make a mortgage payment. I said, well, let me show you another tool. If I can show you a way where you can buy a $400,000 with half your cash and put the other half back with your investment portfolio, would you be interested? And guess what they said? Absolutely. So here's how it works. You can literally buy a house for $400,000 by simply putting $200,000 down as a down payment. So let's just say 50% roughly. The other 50% is going to be the actual reverse mortgage loan. There is no mortgage payments for the rest of your life. It accomplishes the exact same goal. They just bought a $400,000 house with how much? For 200 grand and no mortgage payments. But what are we going to do with the other 200,000? I have a financial, I just talked to an insurance agent yesterday. That's all she does is insurance. And she goes, George, I got one exactly like that that's happening. She goes, I'm going to take I'm going to educate her. We're taking the 200 grand. We're going to put it in an annuity. I already talked to her about this concept. So I didn't bring it up at all. I didn't tell her that she needs to put it in an annuity. She brought it up on her own. And we're taking part of her cash to generate income from an annuity. That's what she wants to do. But I'm trying to show that you can use this tool instead of tying up all $400,000 of cash. Why do we want to do that into an illiquid asset? Let's take the 200 grand, the difference, and put it back into our investment portfolio, whether it consists of an annuity, a life insurance policy, whatever it might be in your investments. But the bottom line is you want to put it into a bucket that's liquid that you can have generate some kind of income in your retirement years. So anyways, that's my last point I wanted to make about purchasing a house with a reverse mortgage. So hopefully that helped out. All right, let's see if I got anybody have a question real quick before I move on. If everybody gets my email address, I'll be more than happy to email you some information and educate everybody on a local level, on a personal level, and can go over some case study sheets. But I would really like for you guys to reach out to me so I can just run by different scenarios with you and see what I can do to probably help you out and show you some strategies of how you can help increase your insurance business or help you if you're in the financial planner segment, how I can show you tax strategies and some of the things we can do to help offset some of the tax liabilities that's out there. All right, Tom, now I'm officially done.
Okay, well, thank you, George. We really appreciate it. It's been a pleasure having you conduct this class for us, and it's nice to have all of you on as well. I don't see any specific questions here that have come through, but if you do have any, feel free to submit it to George. He's got his information in there in the chat. And George, again, thank you for doing this and providing this to our members. This is a benefit of NAIFA Florida membership, and we're honored and proud and glad to be able to present these types of educational opportunities to all of our members. For all of you, please feel free to reach out to our NAIFA Florida education calendar. It's on our website at naifa-florida.org. Click the tab at the top that says Get Involved, and then go to the calendar from there. And all kinds of opportunities there, some CE, some not. Programs Without Borders, some of our local chapters around the state offer their meetings statewide on the Zoom platform. And very interesting, lots of opportunities there to pick up new education, new ideas, and some motivation as well. So again, visit the calendar, NAIFA Florida, check it often. As you can see in your email, we're promoting those things often, but doesn't hurt to take a couple minutes at the end of the day just to check the calendar and see what's going on there and how NAIFA Florida can be of service to you. George, thanks again for your time. Everyone else, thank you, and nice to have you on today.
Thanks again, guys. Have a good day.